The Atlanta Fed's estimate for the first quarter has consumer spending at 0, and that's a recessionary reading. So that, I think, kind of contradictory to this idea that consumer spending in the aggregate is holding up well. And then, of course, if you strip out the things that people have to spend money on, like housing and healthcare, the spending is clearly in recession territory. And then what we saw with consumer confidence yesterday in University of Michigan and all these surveys that reinforce the idea that consumers really aren't feeling that great. But going back to the idea that, the top end of the K is really supporting things. And it's true, GDP doesn't care who's spending the money as long as they're doing it. Obviously, all of that hinges on what happens with the stock market. And if the headwinds, the downward earnings revisions and the corporate refi wave and the struggle to service debt at higher rates around that begin to weigh on stock prices, and, the correction that we saw unfolding earlier resumes, then you've got a real problem, because that top end of the K, whether directly or indirectly, is spending their wealth. They're spending their psychological market gains. So I think that would be a huge drag on consumer spending. This is why I keep coming back to the idea that the stock market is the tail wagging the economic dog anymore. And so I don't have a strong argument about the high-end consumer presently, but I will tell you that if the stock market craps out, you will definitely see that reflected in the consumer spending numbers. Right. I mean, you're either very financially ignorant, which is hard to believe anyone could be that ignorant, because you do get the bill at some point. But yeah, it does seem like a sign of stress. And like you said, on the other hand, folks that are very willing and able to take advantage of that stress by coming up with newfangled ways to exploit it and lend to people that really shouldn't be borrowing, certainly not for those kind of expenditures. So yeah, it's scary. But, we've seen this bifurcation of the consumer for so long, and people pay a lot of lip service to it because so far the issues, the stresses haven't been big enough to really topple over anyone super important. But we have seen, a huge increase in credit card delinquencies and serious auto loan delinquencies. So all of that is clearly happening, but it hasn't slowed down the pace of lending or borrowing, near as I can tell. It is interesting to see how they just shovel more and more of these products at retail investors. I know that there have been a number of funds now coming out that give them exposure to private credit, so you can get some of this too. Yeah, it's a little scary, but these are the kind of things you generally see at the top. Of course, we've been seeing these kind of ETF offerings for quite a while, so it's hard to know. I figured once they started doing the private credit funds that you were probably near the end, but I probably would have said that a year ago. Absolutely. No, I share your cynicism about that. And I think it's well deserved, because we've watched this happen so many times at this point that it's just hard to believe they won't revert to standard operating procedure. And again, because I think there's this level of opacity around the private credit, the fear of the unknown is so great that they'll just want to throw, a life raft and create some big enough response that it allays any concerns, because they can't really quantify how big the problem is. So I feel like the impulse to do something, what did they say from Animal House? This situation requires something, big and stupid be done on somebody's part, and we're just the guys to do it. I mean, I feel like that we'll see that one replayed a little bit. I continue to be very surprised by oil, positively, in that as soon as Trump was elected, and, he campaigned on the idea that he would solve these problems both in the Ukraine and the Middle East. And so when he was elected, you did kind of have this idea that you would have expected oil prices to come down, not only because of drill baby drill, but because of the idea that we would be nearer to a peace deal in both of those regions. And yet oil, as far as I can remember, has been around $68, $69 a barrel. It's pretty much been churning around that area. We did dip down a little bit below it and a little bit above it, but basically that's where we've been. And peace deal, no peace deal, ceasefire in the Middle East, no ceasefire. That's where oil seems to be. We've got this backdrop of incredibly weak growth globally, and yet oil just won't go down. So I guess that's kind of my question is, if we get these deals signed, sealed, and delivered, is that when we see oil go down, or are there forces that are just so strong underneath it that this is going to be the price? I mean, it does feel like they're targeting a price around $70 a barrel, and that's OPEC or whoever is going to try and sustain that level, which doesn't really, that's just one sort of facet of this question you asked about peace. But I think as relates to risk assets, I don't know that it would materially change the backdrop. I think oil would be the main window into the main thing that I would expect to react. I see if we got a peace deal tomorrow, maybe we get a brief rally in the markets on that. I don't know if it would even sustain through the course of the day. I don't view it as a big enough deal. I think that anything that moves us away from this era of the weaponization of the dollar by trying to normalize relations with Russia and in some way kind of acknowledging that what was done probably was a step too far, in terms of seizing their assets, might be bullish for the dollar in the near term. As to whether it changes the long-term dynamics, I think that's a much larger question, and I'm highly doubtful that it would really materially change the impulse of foreign central banks to seek alternatives to the dollar, just because our fiscal situation isn't in any way improved by a peace deal in Russia. We still have, that's the elephant in the room really for us. And the weaponization of the dollar was just kind of maybe the straw that broke the camel's back. But the real problem has always been our runaway fiscal situation and our ability to print money and abuse our exorbitant privilege of the dollar reserve standing to finance it. Well, I mean, I think it's a huge positive long term. And I guess the question is, right now, these are just announcements and they're pledges. We need to see when the reality actually happens. And I would say, if the economy continues to devolve, if growth continues to slow, these plans will be implemented in a very drip kind of fashion. So the numbers add up to quite an impressive tally if you were to imagine that they were all going to hit the economy, in the next 12 months or something like that. But that seems highly unlikely. And then you also have to think about how much of this money that is being discussed is just money that's being repurposed from, hopefully it was money that they were going to spend developing plant and equipment and supply chains elsewhere that they're now reshoring. But then the question is, are they now having to pay a higher price for that? And what does it mean for margins and this kind of thing? So it's a lot more complicated than just, okay, we're going to pledge all this money and it's great. It's going to be a boon to the economy. It will be over the long term, but there are a lot of moving parts to that in terms of how it gets implemented, when it gets implemented, and then, what the actual cost benefit is for them. Now, hopefully, we get a tax deal that rewards these companies for actually investing here in the United States. And if we had something that was formalized like that I think would be a game changer, that said, you're now, if you build it in this country, as Trump has proposed, you'll be taxed at this rate. And if you build it elsewhere, it'll be a different higher tax. So I think that's what we really need to see is the tax bill. And I've been a little bit frustrated and confused about the emphasis on tariffs right out of the gate and putting taxes on the back burner, because the taxes are the thing that really are, I would think, going to liberate companies to pursue the CapEx and hiring and really have clarity about what their business model is going to be going forward.